96%. That's the number of stocks that were up over the last 24 hours in the S&P 500. And with two large sessions over the last 10 days, could it be that Wall Street is finally buying the dip? Well, as it turns out, in today's video, we'll share with you the dark pool liquidity that made it all happen. And it looks like there's some big moves going on around the world. With digital gold becoming the new big thing of the last 48 hours, as we suspected, gold itself took a bit of a dive. And in today's video, we'll share with you the data surrounding that, along with the big earnings season that is kicking off. Even though Tesla had a bad result, the stock still rallied. Why was that? Let's take a look today as we cover stocks, commodities, and cryptos together. This one's not to be missed, guys. We'll see you in a moment. Well, welcome back, everybody, to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the data, and of course, the key levels coming your way. But let's kick things off with the 96% breadth day that we just witnessed on the markets, the second of the last 10 days. As you can see here from Subu Trade, this is a pretty good statistic when we're talking about forming structural base. And although it doesn't mean that we won't see a lower low in the future, in fact, that happens quite often in these particular reads, such as 2015-16 and 2011-12, this can be a great sign of forming what is a very key level for investors and position-based buyers. In fact, 2 months later after seeing reads such as this, we are 100% up in terms of the markets, and the percentages are not too shabby either, an average of 7% over that period of time. And this is what we've long suspected. We're going to trade in this trading range with huge up and down days, and in particular, movements that are going to shock many retail investors like you and I. Now, let's take a look at what actually happened in terms of the investment overall. As you guys can see here, there were a couple of large trades that came through, specifically in some very, very key markets. IVV, one of the biggest S&P 500 ETFs, just got its 5th largest trade ever during the session. On top of that, we saw the SPY, one of the biggest market index positions, defending the 6th largest trade zone. And of course, we saw some big sweeps and dark pools coming through large cap funds such as SCHG and a few others. And this is a big deal because this is exactly what we were looking for over the last 24 hours to tell us that there were people buying the dip. On top of this, we've come back to a key zone such as the daily 20 moving average, which we'll look at later on. And we potentially are making a higher high, which is the first change of trend that we've had over the last kind of half a week to week. This is great for day traders, big for swing traders, and of course, a positive sign. Now, if we look at all of the sell-offs in history, really the one that makes the most amount of sense right now is the 1998 analog. Well, this continues to hold very strongly. In fact, what traditionally has happened is the market sold off, formed a base, rallied, dropped, rallied again, and then, of course, went back down to make what we call a double bottom. Now, as you saw before, that actually becomes very likely as well when you have these 96% breadth sessions. And what this is good for is it's good to kind of say, okay, well, this is a key holding zone for markets. When markets get down into this bottom quartile, then maybe you want to be a buyer. When markets are up near that supply or resistance zone, maybe you want to be a seller. And it's that perfect period for the day trader, for the scalper to be involved in markets. For investors, it's like very frustrating because, of course, you see your portfolio go up and down 5% on a whim on a session. And unless you've been in something like gold or maybe even Bitcoin in more recent times, such as last week, you probably have seen your portfolio switch quite a lot. If you are a believer, though, that things will improve, then this is probably the best analog for you. And that is the 1998 to the 2025 overlay. And at this stage, it is the most correlated that we have. Now, on the bad side of things comes this chart. We've shared this several times, which is, of course, the Cisco or the dot-com bubble with NVIDIA. Now, if you look at it, NVIDIA, semiconductors, technology stocks, all of those really need to improve to get another bull run going. And at the moment, we find ourselves in this chop, basically a zone where the markets are going up and down quite a lot. And if we do break down too much more, we'll effectively enter into what's called the recessionary path or a structural break. And this is of course, very negative sign for markets. So what happens here is incredibly important. and will probably define the next 12 to 18 months. On top of that, CTA positioning for the bulls is still good. Now, we first reported on this around 2 weeks ago, and since that point, we've actually seen a little bit of CTA purchasing, which is good because basically this means momentum is starting to shift from the oversold into the buying across the board. And this is the type of thing that we want to see at these lows. On top of this as well, smart money seems to be buying these dips for now. Now, this doesn't mean that you go in there and you say, wow, smart money's buying, let's all go crazy. But when you tend to see these particular drops, some notable periods, 2009, of course, 2011, 2018, near the end there, of course, the tariff period that we talked about, and 2022. When you get these huge upticks in smart money, that is a good sign that somebody is at least seeing some value in markets. On the flip side of this, we will ultimately need bulls to come back and really support this market though. So although we're in a dip, we do need sentiment to shift towards the upside. And this is what you would call max fear, or at least close to max fear. No matter what sentiment indicator you're looking at right now, as we've shown several times before, most of them are so fearful that it leads into things such as 2009, the bottoms, or even a 2001, 2002 style period. Now, what about this one, CAPX? Well, this is bad because, of course, when we tend to see CAPEX hit these levels, this is not a good sign for the future growth of the US. And the latest data here, according to Renaissance Macro Research, it's not so good. So CAPEX seems to be failing. And this is not the type of thing that you want to look for when you're going for 4, 5, or multiple year growth. When it drops like this, it really means that we need stimulus. And basically that means the Federal Reserve or some form of government support. Tax cuts, anybody? That is, of course, something we may be looking for in the future. Now, this has recently dropped off a cliff. And that basically means that no one is looking at spending money in the US moving forward, or at least this seems to be dropping heavily. And that is, of course, a big concern because if we don't see this pick back up, it could have dramatic ramifications for the next 12, 18, or even multiple years. Now, some other times where we've seen huge drops like this were, of course, one of the periods here back in 2011. We saw it during the first tariff kind of area during 18, 19, and that ultimately was supported by, remember, the Fed up until the COVID saga. And we've seen it dropping already over the last couple of years. But this steady decline or this steep decline that we've just seen needs to be watched, and we will be tracking this throughout the rest of this year. So make sure to subscribe if you're interested in that data. Certainly a worrying sign for the people out there that are looking at macro and thinking about their portfolios in the years to come. Let's now have a look at Tesla's report. So basically it was bad. I mean, it was really bad. And it doesn't really matter how you cut it. Some people are trying to cut it as perfect and it's all great, but really it was pretty bad. The key, though, is to understand that even though the markets see this terrible result, they ended up going up. And you might be left scratching your head saying, why is that? Well, it's a mixture of puts, as you'll see later on, which is just huge amounts of puts sitting at 200, 220, which has been those bases we've talked about. And even people were stacking 170 puts, which is actually the next major support level if we did drop 200 over the last 24 hours. Now, all of this helps to create what we call like a bit of a bounce effect, which is that period of time where effectively the market's already sold off 40, 50% on the stock leading into these earnings. So, even a terrible result can be seen as possibly positive. These are the big things here, though, of course, and you can see nothing really met Wall Street's expectations. The key here is to always say, is it a sell the rumor, buy the fact, or is it something else? And in this case, of course, it was a sell the rumor, buy the fact. That doesn't mean, though, that Tesla's through the worst of it. And of course, I would still expect it to struggle off this year, but at least some temporary relief for investors and traders out there. Could we be hitting 280? We'll take a look at that later on. Now, I thought before we discuss our gold segment here that I'd show you this little video down here, which is a video that came out of China. And there are some reasons I'm doing this. So obviously you can see here that it's a machine that allows you to put kind of any jewelry or anything like that in it, melts it and effectively converts it to cash and then puts it in your bank account. Now that's fairly wild in itself, but the reason I bring this up is often when you see these types of things, if anyone remembers Bitcoin tellers, it can sometimes actually time the high of markets or at least be around those periods. Now don't get me wrong, you guys know I'm a lover of gold and I think that it is going to be a pretty good investment over the next coming years. if you are aware of its risks. And one of its risks is, of course, liquidity, and the other risk is overhype, which can happen. And of course, because central banks have been purchasing it, which by the way, we've been talking about for 2.5 years, so it's nothing new, the biggest and easiest money has been made in gold so far. And we're in the kind of last form here before we consolidate and then probably fall due to a near liquidity crisis and then hopefully regain from that point. So am I super negative on gold? Not if you had like a 4 or 5 year horizon, but of course the temporary highs are most likely getting close to being in. And we did see gold fall over the last 24 hours substantially after hitting that 3,500 on some of the gold markets, depends which one you're looking at. Now, why is this important? Well, of course, the value of call put volume was absolutely insane. We saw the rate of change go ballistic, gold versus the S&P. Whenever this happens, of course, we tend to be at those highs. And we've also seen some crazy ratios. Now, one of those crazy ratios has been gold to silver. Now, you know that I'm a bit of a bull on silver now after going and, hunting gold for the last 2.5 years. And silver has been, it's okay, but it's been lackluster. And basically, we are now at a point where silver is historically undervalued. It's not the absolute worst it's ever been, but it's getting damn close. And what this tends to have done in the past anyway, is it means that silver becomes a more interesting asset and that often people go to alternative assets. Now, one of those is, of course, potentially Bitcoin, which has found a lot of strength as we first reported on that particular thing. But just remember, gold, after it hit what it did over the last 24 hours, tends to do pretty poorly over the next 9 months. And this can be kind of, a bit of a sad thing for a lot of people. But you've got to remember, it's most likely in consolidation unless we're in, and this is a big unless, stagflation. If we're in stagflation, which was the 70s period, gold is the best. So just remember, we could be in what we call a consolidation here for gold. And that's backed up when we look at the dark pool liquidity. Last week, the biggest trade we've ever seen on PHYS, which is a big ETF, a big exchange traded fund in gold. That's a huge deal. Now, we mentioned before that this could be okay for Bitcoin. In the past, we've seen when traditionally we get these types of reads on gold, that gold is a little bit overpriced and it's getting a little bit high, that Bitcoin can start to play catch up. As we know, Bitcoin is often considered digital gold. So far, so good. We hit this level, and obviously we've seen Bitcoin start to really go ballistic. Could it continue? It certainly could, and I think it needs to be at least considered that people are starting to do that. Now, we mentioned before that the current economy is at a precipice, at a change in a market structure that could either send us down the full recession line, which we may have already actually broken, or, of course, the chance of a recovery. The problem is these tariffs. And as we know, the thing about tariffs is that they end up causing initially potentially an inflation, then a deflation, and then, of course, a demand crunch. Now, this is something that we've already talked about, but I mention it again because I think it's one of those important factors just to think about the inventory as well that's been purchased. At the moment, people are running out there and buying everything they can before tariffs take hold. That is effectively causing a front-loaded stimulus in the economy, which means that earnings could be pretty good. It also could be that many businesses have 3 to 6 months of inventory stocked up before tariffs, which could also mean that we've got a good level of structure here for a while in markets before the real damage is done. I think it's very important to keep this in the back of your mind. We're obviously on a 90-day hiatus at this point in terms of the major tariffs across every country, and deals could be done. Some of the deals that you're wanting to look for, of course, the two major economies being China and India. And we've already seen India kind of, getting some positive light here in terms of a deal with JD Vance and everything else that's going on there. And these could be seen as big catalysts for, of course, the markets to try to regain their strength. Now, we've got Tesla out of the way, and it was not very good. But again, the markets managed to rally. The big question now will be these two. Now, we already saw Intel over the last 24 hours come out, and they said, we're going to sack 20% of our staff. The stock was obviously up off that, and that actually could be basing the stock itself. But remember, Intel's earning result is going to be a plus minus 10% expectation by the market. IBM coming out plus minus 9 on Wednesday afternoon, and Alphabet, that's going to be a big deal, plus minus 7 on Google. So that's going to be a big one as well. Probably the biggest one this week is going to be Google. We already expected Tesla to be poor. It was. The stocks obviously rallied off that. But Google, remember, just hit its 61.8, the golden pocket over the last 24 hours, and it managed to find buyers. And that's very key because that was happening across all of the mag stocks in recent times. Let's now talk about recessions. Obviously, the chance of us going into recession is much higher than it was at the beginning of 2025. Some people are estimating as high as 90% chance, in fact. Now, of course, the way I always look at it is we should be looking at structure and also looking at the stats themselves. In 2022, we avoided it. In 1966, we avoided it. And 1987, we had a flash crash. I think it's important to note that this and this period here are the most closely correlated to right now, and both ultimately ended in recession. So I think that is always a worthy concept to think about when you're looking at this market structure. And of course, as we find out more information, we'll share it with you guys so we can all find out about this together. Now let's take a look at the last 5 days. You can see here that surprisingly, or maybe not so surprisingly, regional banks were at the forefront of gains. And this comes off the number one largest trade we saw on KRE. Take a look at our weekend video where we discussed that. And actually, it was one of the best returns over the last 2 sessions. Specifically, KRE and financials did 3% as 96% of stocks went up. And it wasn't led by technology. Now, this is the problem. We do need semiconductors. We do need technology stocks to come along. If they're not going to come along, we got big problems. And as you can see, the other problem we're starting to get is although we did see the Federal Reserve supporting the market in terms of as it's been dropping, they've kind of been adding sneaky liquidity. That seems to have dropped off over the last week. So we want to see the Fed supporting the market again and starting to input the liquidity back into the system. So we'll be tracking this quite heavily and obviously looking for that. When we have a look at the SPX, you can see here that the market did find buyers. Obviously, a lot of dark pools in this particular activity right here. And the daily 20 moving average remains one of the key resistance points through this entire selling off period. So we didn't quite hit a 61.8 on the S&P. The chance of a double bottom is still possible. And we've got to remember that in past analogs, that's actually the way the market played. So this was the type of situation we ended up getting ourselves into. For now, though, the futures market is pretty active. It's just hit the resistance for sellers or bears. This is going to be the zone that they'll want to be selling off at. And it just hit that just as we're recording right now. And of course, it gapped up after the earnings results came out. And just in general, the market's kind of got a little bit hyperactive on a couple of pieces of news that came through. Now, this is good and all, but let's have a look at the options market. And it was a mixture of huge amounts of calls that came in and a mixture of course, those puts holding up the market. 5,100 was the most put struck over the last 24 hours. Then we started to rally back up. And of course, now we're at that kind of resistance area, which is that 5,350 to 5,300 zone. Now, this is where the most calls are over the next 24 hours. And we're still in what we call negative gamma. So we've got to remember we're still in negative gamma. The market is still technically towards the downside. But if we just actually go back over here to the futures market for a second, what you're going to notice is the futures structure actually made a higher high. So have a look here. We've got this market kind of coming down. And then all of a sudden it strikes above 53.35. And that means that if the market then sells off, remember 5,200 seems to be where we have a lot of dark pool liquidity. There could be some buyers that recommence trying to purchase back up at this point. And that could push us to that big supply zone, that big resistance zone sitting at 5,600 to 5,670. So that's going to be a key area to look at. Let's now have a look at Tesla. It was puts galore. Everyone was stacking a put before the earnings. This is why predictive kind of nature trades aren't really that good. Were you correct that the result was bad? Yes. Were you correct on the positioning side? Probably not, especially if you're going negative. This person is still crazy, the person that has the 950 calls. But anyway, they love their 950 calls. And I'm pretty sure they're going to lose on those positions. But either way, let's have a look here. We've got the 262. We've got the 260 in general being the call wall at this stage. And that's, of course, going to be the level we want to watch. After hours, Tesla was up more during the earnings call and it hit into the 250s. So about 260s where I think there could be people starting to take profit off the table after that pretty large move to the upside. Let's have a look at Nvidia. Nvidia came back to almost 100 after hitting the 61.8. Again, 105 is now the call wall. About 100 to 95 is the put area. And basically the market is sitting in between this zone. So realistically, what have we got? We've got a market that is trapped within an area and it is not out of the gates just yet. Let's now have a look at the lead indicators. So first up here, we'll start off with the US 30-year yields. Just remember, they are still high. And if the US 30 yields get above 5%, that is going to be a warning sign because that may need the plunge protection team. So that basically means the Fed or the US government may need to come out and say something. Remember, their hand was shown that they are watching the bonds market more than anything else this year when we saw that 5% hit on the US 30. And that's going to be, I think, the key yield to be watching at this stage. In terms of bond market yield spreads and junk, you can see here that it's stabilized at these levels. So obviously it's not too bad. And treasuries, of course, has stabilized as well in what we think is like the bull zone. Although I wouldn't trade treasuries. We say this all the time. Treasuries are okay if you've got like a really long-term plan. But of course, they're not quite what they used to be. And there has been a couple of attacks on them. Let's have a look at the US dollar. The US dollar, as we suspected, came into that sneaky demand and has found buyers. Now, has it changed trend towards the upside? No. Could there be a couple of good currency trades coming on? Potentially. But you've got to remember, this is supply. The market has come back into those and found a little bit of short. So we'll be looking for the US dollar to come back up. And what I've noticed is the ability or the amount of people just selling this idea that the US dollar is dead and everything's bad about the US dollar has really gone high. I'm sure you guys are aware. Every second article, every second video I seem to get recommended is something about the dollar dying and the end of the US and all these other things. I never really fall into that category. The thing with the dollar is it was always going to go down this year. If you remember back in February and January, we were already looking at the US dollar's decline. And I think it's too early to really get caught up in this idea the dollar's dead. I mean, here's the dollar index over time. And you've got to remember, back over here it was 76, over here it's 98. So, really, I mean, it's not even back to where it was in 21 or 2018. So I think people need to just take a look at this and say, well, let's be objective about it a little bit here in terms of what we're looking at. On top of that, we need to check out gold, which obviously has come off its high of 3,500 and it went back down to 33. Now, I would say this is a consolidation area for gold. I think gold is obviously good, but I think we've probably come off the consolidation. So I wouldn't be, too surprised to see it kind of do this for a bit and then hopefully regain strength in the future. Now, does that mean that silver's over? Well, maybe not. Hopefully silver can start to play catch up similar to Bitcoin, looking for it to break the 3320 zone. If it can do that, then hopefully we can get past 34. And remember, it's so far behind gold. It should be at about 45 to 50 an ounce by now, and it's not even at those levels. When we have a look at oil, you can see here the inverse head and shoulders and the completion to the upside could be coming very, very soon. So that's, of course, looking okay for the people that are bullish there. I think it's a geopolitical risk, but anyway, that is definitely a position. And of course, if we're looking at Tesla, if you were the one that was going against the trend and you were saying, you know what, I think it's going to be a buy, you bought off 220, then of course, 260 is going to be the zone that you're looking for, and you're probably going to get a 250 plus on the open. Regardless of bad earnings, that's the way the market works sometimes. You can't really, try to interpret that. It's just an oversell. Remember, it's down 40-something% coming into these earnings. So it's no surprise that it could be a buy the fact and sell the rumor. Nvidia came off the 61.8 fib, which is, of course, an okay level, but probably a bit early on that stock. We saw Intel doing a bunch of cuts coming into their earnings. So maybe this is the low point for Intel. Remember, this can be turning points when they sack people. I know that seems bad, but same thing happened on Meta. It often means structural change in businesses. And China markets recovered as well over the last 24 hours. I think one of the better markets, though, has actually been the Indian market, which has been doing quite well in recent times. The Nifty 50, might cover that in the next video if you guys are interested in it. Now, let's have a look here at the NASDAQ. Again, a new higher high formed. So that means that if we come back down and fill the gap, come back into these areas where we've seen those dark pool liquidity zones, that could now be kind of a potential buy for day traders. Certainly something that's a little bit more active here. I still expect up, down, and all around in these markets. You've got to remember we are at that resistance, so bears are going to try to push down here. We have been pressuring it, but the daily 20 has so far been too much for market. So I think that's important to note. And just remember when you're coming in and you're looking at something like a Google as well, it's all the same stuff. So if we have a look at fibs and we're looking at something like a Google here coming into earnings, you can see again that these are those levels that positioners or investors are going to be looking at and saying, it's good, but the earnings result will ultimately be, how it's going. I would say the YouTube particularly, which of course you're watching this most likely on right now, this is, I would say that platform has been smashing it, because what I've noticed is that huge amounts of people are watching alternative media, and I can't see YouTube not making a mozza on ads and stuff. So that's going to be a really interesting report. I could be wrong, but we'll find out whether they've got good earnings. I think post the election, it's been absolutely wild, though, the amount of people watching alternative media. What do you guys think in the comments section? Let me know down below. US 2K, what's going on here? Well, of course, we have a market that has actually recovered better than the others. So the US 2K, although getting slaughtered back down, has actually come back better. It's actually about to make a new high. Now, it's nowhere near changing trend or anything like that. But, there are some signs. I mean, this is a decent base at 1800. That's pretty good to get up here. And again, it's finding itself at resistance. Probably the standout, though, of the last 24 hours was Bitcoin. We suspected it would be. It's already come up to 94,000, which is basically a little resistance. I'd like to now see Bitcoin kind of drop, maybe come back into these levels here, and then find buyers back in. It's actually changed trend to the upside now and on a lot of swing trends. And of course, if it is going to play catch up to gold, then that could be really beneficial. But you almost don't want to smash into this supply yet. You kind of want to sit around here, do this, do that, and then like that. And that would actually be a much more refined trend. But either way, very good run here for Bitcoin. Hopefully it can hold up. And of course, it wasn't just Bitcoin. It was the other coins did also find some resilience, although all of them are now at a resistance of some kind. So it's kind of like resistance on the S&P, resistance on the Ethereum, a resistance on Bitcoin, resistance on gold. A lot of things hit resistance after having that really nice uptick. And that's probably why you see with the stat that we shared at the beginning that sometimes it can be a little bit negative the next session or two. But ultimately, it's a good beginning here for potentially a 2-month structure reset. And that's something that I think is quite exciting. 100% stat is always a good, cool thing to see anyway. In terms of the data moving forward, we've got a bunch of European data. Flash manufacturing PMI, people will care, but ultimately we're going to have to be paying attention to the price action and the big dark pools. And then, of course, we go down and we're starting to get more bank holidays for many places around the world, including here in Australia. Just remember, it's a shorter week for some liquidity. We do need to be aware, of course, of everything that's going on. It is earnings season kickoff with big tech. Next week's going to be wild. Make sure to sub for that. That's going to be absolutely crazy. And of course, we will continuously watch for these tariff and big deals to be made. I think India is most likely to be the first one to be announced, so watch out for that. And of course, if you want to check out more things, follow us over on X. Thanks so much, guys, for watching. Hope you have a great day, and we'll see you for now.